Shadow banking system. Financial intermediaries that take part in credit creation but are not regulated are referred to as the shadow banking system. Banks are essential to the economy because they support the credit system by accepting money from depositors and lending it out. Bank operations are typically subject to intense examination from financial regulators in both their own nations and other ones. Shadow banks, also referred to as non-bank financial businesses, NBFCs, can frequently function with little to no regulatory monitoring. Hedge funds, private equity funds, mortgage lenders, and even sizable investment banks are examples of shadow banks or financial intermediaries that are not subject to regulation. In addition to uncontrolled actions by regulated institutions, the term shadow banking system can also apply to financial products like credit default swaps. Understanding shadow banking systems. NBFCs make up the majority of the shadow banking industry and are regulated by the Dodd-Frank Wall Street Reform and Consumer Protection Act. Long before the Dodd-Frank Act, NBFCs already existed. Paul McCulley, an economist and the managing director of Pacific Investment Management Company LLC, PINCO, at the time coined the term shadow banks to describe the expanding matrix of institutions contributing to the then prevailing easy money lending environment, which in turn caused the subprime mortgage meltdown and the ensuing 2008 financial crisis. Even though the phrase shadow banking may sound ominous, many reputable brokerages and financial organizations participate in this practice. Lehman Brothers and Bear Stearns, both investment banks, were two of the more well-known NBFCs at the epicenter of the 2008 financial crisis. Because of the crisis, traditional banks were subject to more stringent regulatory oversight, which caused a sustained decline in their lending activities. The banks tightened up on loan or credit applicants as the regulators tightened up on the banks. More people needed alternative funding sources as a result of the stricter rules, which led to the expansion of non-bank, shadow institutions that could function without being bound by banking laws. The primary reason the shadow banking system has escaped regulation is that, unlike conventional banks and credit unions, these organizations are not permitted to accept readily accessible monies from the general public, such as those in checking or savings accounts, for typical demand deposits. This restriction keeps them out of the purview of traditional federal and state financial regulator scrutiny. These organizations carry out other kinds of financial transactions as opposed to accepting deposits. By describing various credit intermediation operations carried out by institutions outside of the regulatory framework, the Financial Stability Board, FSB, a group of international financial regulators, defines shadow banking. These include credit risk transfer, maturity transformation, and liquidity transformation. History and breadth of shadow banking system. As pioneers in the financial markets, shadow banking organizations emerged. Despite not being subject to the usual regulatory scrutiny and standards governing capital reserves and liquidity, they were nonetheless able to finance lending for real estate and other uses. Traditional lenders must abide by these regulations in order to aid in the prevention of bank collapses, bank runs, and financial crises. In order to pursue higher market, credit, and liquidity risks in their lending, while avoiding the requirement to maintain the capital requirements regulators require of banks, many of these institutions were able to develop financial instruments to do so. Following the financial crisis of 2007 and 8, the shadow banking industry grew and was essential in supplying credit where traditional banks failed to do so. Because of the effects of the financial crisis, regulators scrutinized this growth more closely. The sector has, however, continued to grow dramatically despite the increasing scrutiny. The Financial Stability Board estimates that the non-bank financial intermediary (NBFI) sector, also known as the shadow banking system, increased by 8.9% in 2021, much exceeding its 5-year average of 6.6% annual growth. The NBFI sector made for 49.2% of all global financial assets in 2021, valued at $293.3 trillion. As the economy recovered from its pandemic lows, investment funds played a significant role in this expansion as money poured in and valuations increased. It may not come as a surprise that the two largest economies have substantial shadow banking concentrations, given that the sector holds such a significant portion of financial assets globally. China comes in second place in terms of ownership of assets used in shadow banking. According to Chinese financial regulators, as of 2019, shadow banking assets were $129 trillion, which is equivalent to 86% of the nation's GDP, or 29% of all its banking assets. Shadow banking risks and regulations. Rising loan demand in the U.S. is partially met by the shadow banking sector. Although it has been argued that shadow banking's disintermediation might boost economic efficiency, worries have been raised about the systemic danger it may present to the financial system due to its functioning outside of standard banking laws. Due to the unregulated nature of shadow banking, NBFC assets are not similarly protected to bank deposits, which are insured by the Federal Deposit Insurance Corporation, FDIC. Also barred from the Federal Reserve's Emergency Loans Program, which is offered to banks experiencing a liquidity crisis, are shadow banking firms. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 primarily targeted the banking sector, leaving the shadow banking industry mostly untouched. The majority of non-banking operations are still unregulated, even though Dodd-Frank increased liability for financial companies providing exotic financial products. Regulators are examining how much exposure conventional banks have to unregulated businesses and products as one way to lessen the risks that shadow banking poses. Even while legislation does not regulate NBFCs, limiting their linkages to conventional banking institutions may help reduce the danger that shadow banking poses to the economy as a whole. The Federal Reserve Board has also suggested that broker-dealers and other non-banks operate with comparable margin constraints as banks. China, meanwhile, started releasing directions outside of the United States in 2016 that specifically target dangerous financial practices, such excessive borrowing and stock speculating. What are examples of shadow banks? Plenty of well-known companies are counted as shadow banks. These include asterisk investment banks like Goldman Sachs or Morgan Stanley, asterisk mortgage lenders, asterisk money market funds, asterisk insurance/reinsurance companies. What are the benefits of shadow banking? Shadow banking's proponents claim that one benefit is that it lessens the reliance on conventional banks as a source of credit, because it serves as an extra source of lending and diversifies the financial system. This is advantageous for the economy. Should shadow banks be regulated? Numerous organizations, including the European Commission, support this position. They contend that due to its size, its connections to the regulated financial industry, and the systemic dangers it poses, the shadow banking sector needs to be controlled. They assert that it is also necessary to stop the shadow banking system from being exploited for regulatory arbitrage, which is the practice of utilizing loopholes to get around potential regulatory constraints. That's it for today's video. If you liked the video, please subscribe the channel and click the bell icon for future updates.